Very good afternoon, ladies and gentlemen. Welcome to the Committee on Public Finance, our quarterly meeting. It's always a pleasure and a privilege to have all you ladies and gentlemen here. As per the Central Bank of Sri Lanka Act number 16 of 2023, we are supposed to meet regularly, and this is a conduit. Now that you are an independent agency, this is the conduit through which you formally establish and maintain the link with the legislature. So this committee has a responsibility. And also there is another matter, and that is also part of this law, that if you miss the inflation target up or down, you're supposed to make some explanations, and that also calls for a meeting at this committee. So we usually combine these two, and that is what we are doing today for the second time, as a matter of fact. Once again, welcome to the committee. Would you please, Dr. Dunusinghe, starting from you, identify yourselves for the record.
I am Priyanka Dunusinghe, appointed member, Monetary Policy Board.
I am Ravi Ratnayaka, member of Governing Board and Monetary Policy Board.
I am Nandalal Veerasinghe, Governor, Central Bank of Sri Lanka.
I am Nihal Fonseca, member of the Governing Board and Monetary Policy Board.
Vish Govindasamy, member of the Governing Board and Monetary Board.
I am JPR Karunaratne, Deputy Governor of the Central Bank of Sri Lanka.
Anushka Vijayasinghe, appointed member of the Governing Board and the Monetary Policy Board.
Manil Jayasinghe, member of the Governing Board and Monetary Policy Board.
Nelumani Dawalagal, Senior Deputy Governor.
Sujita Jagajeevan, Director of Economic Research and Deputy Secretary to the Monetary Policy Board.
I am Lasante Sirimana, Chief Accountant, Central Bank.
Inoka Mohutti, Assistant Governor.
Ruwani Gunasekara, Assistant Governor.
Sirikumar Kodakama, Assistant Governor.
Dimutu Samarathunga, Assistant Governor and Secretary to the Governing Board.
Inoka Vikramasinghe, Director Legal.
Shanuri Jayasinghe, Director Non-Bank Supervision.
Nihal Liyanage, Superintendent of EPF.
Samudra Jayasundara, Director Policy Review and Monitoring.
Dulani Ranasinghe, Accountant.
Vasat Alvis, Director Payments and Settlements.
Lasita Padberi, Additional Director Economic Research.
Priyanta Tilakavira, Director Macroprudential Surveillance.
Sureka Katawala, Additional Director Bank Supervision Department.
Prabhat Gamage, Director Human Resources.
Erandi Liyanage, Additional Secretary and Secretary to the Governor.
Hemanta Ekanayaka, Director Communications.
Ayesh Arya Singh, Additional Director Financial Intelligence Unit.
That's quite a contingent you have brought, Governor, today. We also have a fairly strong contingent on this side. Okay, let's get started. We have four documents that you have submitted to us. The first one is the function of the Central Bank as per Section 82A of the Central Bank of Sri Lanka Act for the first 4 months of the year 2025. I believe you are making a presentation. The second one is a report on the deviation of headline inflation from the IT set out in the Monetary Policy Framework and Agreement. You are going to combine that with the first one. Third one is annual economic review of the Central Bank of Sri Lanka, which you are tabling. And the fourth one is the financial statement and operations of the Central Bank of Sri Lanka. That is for last year, which is also going to be tabled. So we have one presentation combining 1 and 2, and then we can perhaps have a discussion on the third and fourth one as necessary. Right, shall we start?
Yeah, thank you, Honorable Chairman. I think the reason that we brought all this stuff here, especially for the first one, report function of Central Bank Q1, first 4 months of 2025, where we are covering all the functions. That's why all the relevant department heads of departments are also here in case if you have any clarification. With that, I think we have one presentation combining the breach report and also the functions. So that together, I'll invite Director Research, Dr. Sujitha Jagajeevan to make the presentation first, and then we can open up questions or comments, please. Thank you.
Good afternoon. As Governor explained, we have combined the discussions required under Section 80, subsection 2.
Dr. Sujitha, how long do you think you need?
For presentation, half an hour.
Okay, should members ask questions while you are presenting, or you want them to wait
That's
till
fine.
you finish?
That's fine.
While presenting?
Yeah.
Okay. Okay. So clarifications now and substantial discussion subsequently. Thank you.
So let me start with the requirement under Section 80, subsection 2. It requires Governor and the members of the Governing and Monetary Policy Board, Deputy Governors of the Central Bank, at the request of the Parliament to be heard by the Parliament or its subcommittee in every 4 months. We last reported in January, and this is the second time we are meeting this year. And let me start with the objectives of the central bank. The primary objective is to achieve and maintain domestic price stability, and other objective is secure the financial system stability. So today's presentation has been summarized under these two objectives. Under the price stability, I will be talking about the monetary policy discussions as well as the report that is required under Section 26, subsection 5 of the CBA that requires an explanation on the inflation target breach. On the monetary policy decision making, the monetary policy stance remains increasingly accommodative since June 2023, and the policy stance was further eased in 2024 as well as in 2025. And several factors have contributed to this continuous easing of policy stance, mainly the subdued inflation, well-anchored inflation expectations, continuation of tight fiscal measures, as well as strong external sector performance. With these, last year we had around 125 basis points policy rate cuts, and the recent policy easing was effected in May, with 25 basis points decline in the policy interest rate. With this, the easing cycle, which started in June 2023, the policy interest rate has been reduced by 8 percentage points.
So it was how much?
8%.
It was
615 2023, 125 in 2024.
Yeah, so what was it then? 16?
15.5 to 16.5.
Now there is only one.
Now one rate, 7.75.
So can you explain that a bit?
The single policy interest rate?
Yes.
Okay, so in November 2024, the Central Bank decided to move to a single policy interest rate.
From your...
the dual policy interest rate that we maintain, that is standing deposit facility rate and standing lending facility rate.
Okay, now
So
tell
that
us
forms
why
a
you did that?
So we wanted to give clear signal to the market so that there will be better communication about our policy stance, and also for a better transmission of the policy rate. Because what we see is when there are two policy interest rates, the market doesn't know where to place the interbank rates. It can be either towards the lower end or upper end, or maybe in the middle.
What
So we have a
should it not be based on the liquidity in the marketplace at the time?
It partly affects, but also from the policy side also we have to give a clear guidance to the market. Where do we expect, as per the stance, where do we expect the market rates to be? Then if that deviates, if the actual rate deviates from the rate that we are expecting, then we do operations to make sure that it comes to the expected level. When we have a corridor, that signaling wasn't that clear. So we wanted to give a clear signaling to the market. So this is where we want
So the signaling you want to give is for the market rates to be as close as possible to your
To the
that
overnight
is the
policy.
daily call money rate.
Yes, average call money rate is the operating target of the inflation targeting framework. So we want that to be aligned with the overnight policy interest rate.
So the average call money rate is your target rate for.
The interbank, the short-term rate.
So, is that the 7.75 is that?
That is our policy rate. Overnight policy rate is 7.75.
Yeah, but you want the call money rates
yes.
to be close
Yeah.
as possible to that rate.
Yes, currently call rate is 7.74.
So what is the variance? How has it varied over the last since you changed it?
It has been less than 5 basis points.
5 basis points
Up or down, yes.
since you changed it in November.
November.
Prior to that,
Prior to that, because market didn't know where to have, so we have seen most of the time it was in the middle, and depending on the liquidity conditions, if there is excess liquidity, we have seen the rates to be closer to the lower bound. When there is shortage liquidity, towards the upper bound.
so you said you manage it on a daily basis, no?
Yeah.
So your open market operations have been heavier or lesser since the single rate?
So in the recent time, we had a different problem because the asymmetric distribution of liquidity. So even though overall
Meaning
liquidity
between
has
local
been,
banks and foreign banks or what?
Yeah. Even though overall liquidity has been surplus, we have seen certain units have been deficit, and there were issues in market transacting and settling among themselves. So because of that, even though we had surplus liquidity, we have been supplying liquidity through reverse repo auctions. But
So-
that we stopped latter part of last year, and we completely stopped the short-term auctions. We stopped somewhere latter part of last year, and overnight reverse repo auctions we have stopped in February. Now no operations because the rate is very closer to the overnight.
No operations now?
No. So they can come to the standing window, but we are not having regular
So you mean
auctions.
to say you don't do open market operations anymore?
No auctions, but still those standing facilities are available. So the excess unit, if they
So
want
you
to come and
do
park,
with each counterparty bank?
yeah, they have that option. The standing deposit facility and standing lending facility are open to them. So if they want to park money, they can come and deposit. If they want to borrow, they can borrow at the lending rates.
So does it mean that you are trying to fix the rate?
I think, let me clarify this, why we move into this thing. Earlier when we had this ban, usually within the ban, but our Montreal framework is basically more effective. When we target daily weighted average call money rate is the target rate as already mentioned. So for us to target it properly, that's why recently we moved to single policy rate in line with our owner's policy rate. So what happened in the past, when we have a band, this band is 1% before we move into single rate. When we have band of 1%, daily basis, this call rate is varying between not exactly the middle, some days responding with excess liquidity, short-term liquidity, moving 10 basis up, down, likewise volatility within the couple of days was high. So that basically confuses the market of our monetary stance, because for example, one day call money rate goes up, market can read the signal the central bank is basically moving towards a tightening part. But it's not. It's mainly because of the liquidity situation, market can move up and down because of the corridor. But to make it clear, we want to target the short-term call rate, clearly moving, that's the target rate. That should be easier when you have a policy rate and the call money rate moving in line with our rate. So then it's easier for us to manage this. Basically, whether we need to have market operation or not, depending on our ability to maintain weighted average call rate closer to the policy rate. That's a very clear signal we are maintaining this rate. If there's any change in the policy, we reduce or increase the policy rate, so that is a signal. Otherwise, in between variation of call money rate up and down, that gives a confusing signal to the market. We are purposely, letting it go up or letting it go down. That can be a confusing signal. This is much clearer signaling to the market, and also it's easier for us to maintain rate closer to the target rate. That's the whole idea. So as a result, some days we don't need to say, for example, daily call rate, market also have taken it very positively. They basically transaction very close to the policy rate as a result of our signaling, or clear signaling that this is a policy rate, market is trading around. So that's a good, better interest rate transition to the market. Otherwise, you say call rate moving, say 20 basis point up, 40 basis down within a day, it can have impact on the primary auctions or T-bill rates, shorter term rates, or repo rates. That bit of a volatility is not good for monetary policy implementation. That's the reason.
I'll ask you a question, layman's question. Suppose the banks have excess liquidity. Suppose the banks can't lend. They have money. Right? So then what happens?
So then that's a facility we have. The bank is up to the bank. If they are to lend, if they can lend in the market, in the interbank call market, they can lend at closer to our policy rate. But for some reasons, some foreign banks are not willing to lend to other counterparty banks, then their option is at a cost. Say 8% is that they can park money at 7.5%. They are losing 0.5% because of their choice. Otherwise, any bank with excess liquidity can come to the market and lend to another bank at this middle rate. That option is always there, but if they are not willing, then they have to park that money, and then they get a lower yield on overnight basis.
So does every bank have to be square by the end of the day?
They do. Basically, if they say liquidity, if there's a surplus of 100 billion, if 100 billion, 75 billion is with the foreign bank, they are not basically lending in the market, they park it here. So then there will be, some banks need that deficit to be financed within the market. So there are two options. One is balance 25 billion they can borrow from the market, or else they have to come to the lending facility, which is little higher. And then they have to pay additional premium for them not being able to come to the market at this rate.
I read a very interesting half-a-page article by the central bank yesterday on liquidity and quote-unquote money printing. Why did you have to do that, and what do you expect to sort of achieve from that explanation?
These are, I think, what we are trying to communicate operations for beyond the marketplace, for them to be able to understand our operations. We are trying to communicate in a simple language for public consumption, how we do it, and otherwise there are a lot of misperception, misleading ideas being circulated in the media, looking at the day-to-day liquid surplus or deficit. All these things basically confuses people who wouldn't have good understanding. This is a part of the communication. We have a series of articles, op-eds on our operations, so just to make awareness of the operation. This is a bit complicated, but I think that's the whole idea.
Since the communications director is also here, I read through it. I understood it, but I doubt very many people understood that complicated technical jargon. So since the director communications is here also, and I asked what your objective is, I think you should sort of bring down the technicality next time that you try to explain this to the regular layman.
Certain things we can explain with, that's why you should look at some of the communication, layman language, so over deflation, inflation, we have some comics, some of the social media posts are being published. But this is a little bit more technical, this thing, difficult to make it very simple unless we explain the whole thing, but no one is interested to read those long articles.
Governor, small clarification on the single policy rate. Some of the overseas banks who may not be willing to give it out there will come and park it obviously at a hit. They'll take a hit out of that one. And then a local bank who want to then access to that money from the central bank, when they are getting it, they will get, I suppose, not at a much higher premium than that they would get it out from the market. So as a result, the overall cost will go down. There will be a net benefit to the market as well.
No, that's why, for example, some days for example, even though there's a early example, 100 billion the surplus, if foreign banks are parking 75 billion, then 25, there's a deficit of 75 billion. If you think there are other banks wanting to borrow in the market, then that's where we conduct open market operations, and we conduct operation and then let them bid in the auction, and that's where we auction rates should be closer to this rate. So they basically, we don't want all the banks to have higher, borrowing costs as a result of others are not lending. That's why we intervene and provide them liquidity on the daily basis, overnight basis.
Now, this settlement of surpluses and all go through the RTGS?
All the settlements are basically going through the
End of the
RTGS
day,
system.
that's the
Yeah.
settlement process.
Yeah.
And on the RTGS, what is the total value for a year?
Yes, I don't know whether
Brilliant.
settlement.
Daily nearly 1 trillion transactions, so around
No,
two.
I'm talking the value.
Yeah, the value, that is the value I am telling. For a day, for a particular day, it is nearly it is little above 1 trillion.
A day?
For a day, yes.
So you're talking of about 360 trillion
Yes,
for a year?
closer to that, not that much.
Is this the same as the financial banking transaction value, or that's different?
No, it is totally different, because for the RTGS system, all are high value transactions which are coming through. In the banking system, it is much lower than that.
What is that value like?
So, say for a year, for the last year 2024, there were 202 million transactions in the market, and the value is 17 trillion.
17 trillion?
Trillion, yes.
A year?
Yeah.
And 17 trillion is what? I didn't quite catch.
It's bank to bank. What we say is small value transactions, retail transactions.
I have one question. So these basis points we have been reducing since 2024 continuously. Do we check another variable as a result? What with this, do we have like few other variables that we want to achieve? In the sense that like the credit availability or consumption, or is there anything other indicator that we monitor alongside this?
We monitor a lot of variables, but basically when we reduce policy rate, it is mainly with the objective of reaching the inflation target or a medium to long term. That 5% target is the target which is in the mind. Looking at that, we see whether we need to reduce or increase to meet that target.
Do you see that happening?
Yeah, of course. That's when we start reducing the rates, inflation is now
It's
getting
through
back.
consumption, is it?
Not necessarily. I think inflation can happen in various ways. I think that's why the breach is sometimes whether administrative price changes can also bring down the inflation, like the tariff reduction. Sometimes high demand for local demand, industrial consumption can also push the inflation up or demand up. Then this exchange rate pass-through can also have an impact on the inflation. So we are taking into consideration all the channels of how inflation can be impacted. Then we take into consideration credit growth is one thing that as we explained, credit growth is moving higher than what we think. It could create some additional demand, and that could create inflation in the future. So those all factors are being monetary money expansion, credit growth, broad money expansion, exchange rate, current account deficit, the reserve positions. All are important variables, and also forward-looking indicators like the purchasing power manager index, business outlook, business sentiments. So for us, we have understanding of what will happen in the next.
Yeah, so basically this is the trigger now that you have. So when you pull it down or up, you just monitor rest of the things, how they are moving as well. The
of course, yeah.
I'm sure you must be doing some regression analysis on credit growth to see what kind of the transmission mechanism is and what the lags are and so on. Because I recall last time you were talking about the transmission lag. Have you got any better ideas now? The minister's question is quite relevant from his perspective also, I think. From the industry's point of view, when are they going to see lower interest rates so that credit growth can happen?
Credit growth is already happening more than what we expected. So if you look at last 12 to 18 months credit growth, I think even now what we expected with this monetary policy path, I think credit has been growing much faster than what we Though that partly because of this government fiscal consolidation also helps. Basically, government and state public enterprises are not borrowing as much as they have been borrowing earlier because of the cost required pricing as well as government fiscal discipline. As a result, there is some space for the private sector credit to grow, that is growing. So that's in line with our expectations. If we think that is too much of this, then we have to, that will reflect either on the demand side or in the balance of payment pressures in the exchange rate. So that's why we are monitoring all these pressures. If that's going to create excessive demand or unsustainable situation.
So I think it's clear, it's reflective. I think the question specifically was, do we know the like when you change now this May that we do this impact will come in September, or is there like a trend analysis?
Yeah, that's usually in our research that we have been doing, usually what we expect. Today monetary policy action will have full impact transmitted in 12 to 18 months. It's not immediately. So that's why we're looking at the inflation forecast coming back to 5% say next year. If that is going to, in the target, that's we have a space. If you see 12 to 18 months period, inflation going to go higher, then we have to tighten the monetary policy.
What's the credit growth per year at the moment?
So last year we had around 800 billion, and this year we are expecting
800
billion.
Yes.
Billion.
Percentage?
Percentage term, it's 10 plus.
A private credit or?
Private credit.
And total credit? Total credit? That is government and private?
Domestic credit.
Somebody can look for it. You can go ahead.
Okay.
Somebody in the team can look for it.
Yeah.
Broad one is broad money is moving around again 10 to 11%. No? Yeah. It's in line with the broad private sector credit.
So actually we have seen a decline in net credit to the government and to the SOEs.
Now it is prohibited from borrowing? Within those limits
But
of
this covers the commercial banks as well. This is a banking system, not only central bank, it's a banking system. Yeah, NCG.
Under the new Act, Governor, the central bank doesn't act, there is no thing of lender of last resort.
Plus it was a different thing. That is for financial system stability. If banks have a liquidity issue,
One of the main roles that the central bank played then was protective role of a lender of last resort. But now that's out of the system.
no, they still will have.
But only for the
But
banks.
then that guarantee comes not from from the government, no?
No,
It has to come as a
from the
reserve
central bank.
guarantee.
Lender of last resort is basically if they are in financial institution basically coming to a liquidity problem, then we can inject liquidity, provide liquidity to the banks or usually mainly to the banks. That facility is still available.
Central bank can.
Central bank can, yeah. That's short-term liquidity. That we can provide. That is one of the major functions of the central bank to provide lender of last resort is a key function of the central bank. In the central bank, not only us.
Under
Is
what
provided
section is
under
that? Under the new one, under what section? is
all that even new one, that facility is there.
Same thing remains.
Yeah.
But only for the government. That was withdrawn except for emergency
that's not
situation.
that's basically direct monetary financing.
Correct, yeah.
Of the
On a housekeeping matter, did you all get tea? All right. I feel bad we are having tea.
Sorry, that gentleman mentioned when you said that the total financial transactions is 17 trillion, you said that's small transactions, correct?
Retail payments.
So what's the when you say the big transactions, how do they get communicated? Is that not part of the financial transaction?
No, those are the reporting of transactions are different. So we normally publish a bulletin called Payments Bulletin quarterly. In that bulletin, we publish all these transactions, the large value transactions from RTGS separately and retail transactions separately.
Sorry, I have one question. So now these rates are coming down continuously. Do we have again a look at the lending rates of the banks? Have they come down, or what? Now the spread is still very high, right?
So this,
we have it in
yeah,
there.
yeah. This
Okay.
Yeah, it's the next slide.
Okay, right.
No, it was this slide. This slide.
Yeah, that's
this
what
is
I'm
like,
saying.
yeah.
So the FD rates are here. So that's
The lending rate is also here.
yeah. But when you really go to borrow from a bank, they offer very clearly. They say we will offer you now 5% because the rates have come down. But when you want to borrow for something, it starts at 14%.
But here, no, average weighted net
Weighted
lending rate is 10.54 as said
yeah.
currently.
The weighted average rate, weighted by loans.
All weighted.
Yeah,
that's
all loans,
10%.
all loans.
So there's about a 4% spread.
Depending on, maybe a personal loan must be at 14%, but altogether the full
No,
volume
the minister
weighted.
is asking between the DR and the LR.
Yeah, the 10%.
It's 6.24 versus 10.54.
So net interest margin, latest numbers is 4%, 4.1%. Compared to historically, it has been around 3.5. Recently, last year, second half and this year is gradually increasing mainly because this, when we are reducing interest rates, basically transmission happens first to deposit rates are adjusted immediately, lending rates are adjusting gradually. So that still the adjustment is taking place in terms of the net interest margin of the banks.
Interestingly, Governor, we had the finance ministry here 2 days ago and they were showing us massive numbers on financial VAT. You think that has any relevance to the spread?
Yeah, that also, when you look at the banks' profits, more than 50% is basically coming back to the treasury as tax. Financial VAT or this thing, basically that part of this thing is factored in the interest margin. So that's usually.
So after, ultimately it's going to the consumer in some way or the other.
Yes, taxpayers' money can again be spent.
Just a clarification, Governor, relating to the matter that Honorable Minister asked here. 1054 is could be the average, but could be the upper end. This is the average value. Do we have some reading on that one?
Yeah, do you have numbers?
10.54 lending rate is the average, factoring large entities with risk levels are different. What will be the kind of higher end on that one on this?
No, there are
depending
on the different products. For example, now the credit card rates are those are not lending. This a credit card is a short-term facility. So you take that out, you have one is a maturity. So longer term loans have higher rates. Then prime customers usually rate is now 8.4, but the non-prime customers add some premium. So there are rates for normal lending people, MSME, SME. Depending on the risk factor, banks have a different risk premium. So it varies from one is the product, other one is the customer risk premium. So there's a range. For example, I think as mentioned earlier, there are some rates, personal loans 14%, owning advances 11-12%, and the shorter term loans are low rates, longer term loans are high rates, and government securities basically are completely with market, close to market.
These very same categories that you mentioned, Governor, by any chance we can have some information. So this is the 1054. Above that, let's say if it is government securities at a different rate and the personal loan, then the SME sector, then higher risk premium ones likewise, different grades. So we can see kind of the average for each of those items. This is once you put everything together is the 1054, but you unbundle it, this will be 1054. Some may be lower than that.
Yeah, I think we publish all this information. It's available in the public information.
Thank you.
Yeah, that's fine.
It's in your weekly report.
No, Governor, just for knowledge, is this spread of 4%, 5% is normal in other countries or is it high in our country?
Honorable Chairman, I think this debate on the spread here has been going on for a long time. Answering the Honorable Member's question, 4% is considered high, generally speaking, compared with some other countries. But there are some reasons for that which also we need to take into account. Now, one reason is in Sri Lanka, the main source of income for a bank is through this interest margin. Compared with some of the other countries where there are fee incomes, trading incomes, the opportunities for that are relatively low in those countries. So the composition of their income, if you look at it, 70% or sometimes even more than that comes from this interest margin. And the other big issue which is often hidden, we are probably the only country in the world now which has the financial services VAT. Now, usually VAT is borne by the consumer. It is a pass. But in the case of banks, it is embedded in what you charge, because so obviously that 18% VAT is also in that spread, because you have to pay on your profit plus then you add on various other things. So when you compare, you have to be a bit careful. You can't compare it directly. You need to make those adjustments. So when you do those adjustments, and the other thing is the credit quality. Now we are still emerging from quite a difficult credit situation where I think our stage 3 or non-performing loans, as you call it, it has come down from its highs, but still quite high. I mean, in Sri Lanka, and it has generally been quite high compared with our neighboring countries. I mean, for a variety of reasons, most of the time. So all that is also costing money. So when you look at all those things and when you normalize for those, you cannot conclude that that there is a difference. I mean, I had done this exercise, I mean, when I was on the other side of the central bank, because central bank always used to come and say that the spreads are too high. So we disaggregated all of these things. And it is not you cannot say that it is high, but of course, sometimes, as the governor mentioned, in the transition, there are time lags. So when the rates start going down, the lending rates do not come down fast enough, which is a fact. So that is an issue. And when rates go up, lending rates go up first before the deposit rates go up. So those transmission lags are there, but in a steady state, it would not be so much of an issue. So I think while there is some scope for reduction, I mean, especially, I have myself been saying that there are certain rates, I think, in the market which are too high, in my view. So something that we probably need to do, but the central bank wouldn't wish to go to individual items and try and regulate rates like that. So we are trying to get the total rate structure down. So that is the thing. So there is some scope, but I don't think there is much scope to reduce it a lot.
On the areas of margin, is there a distortion between the state banks and the private sector, where they are a little more leaner and this thing, and that gap brings the private sector advantage? Their costs are far less than it is. So is that part of
It is a factor, because I mean the private sector banks tend to be, more leaner when it comes to, and if you look at a foreign bank, then it is even more lean. Compared with the local bank. So those distortions do happen, but so the numbers that was mentioned was overall for the whole, covering all of them.
Move from 2 to 5. Now, when you say the lending to, when the minister asked the question, lending to prime companies and the other, it's AWPLR plus a figure that is given.
Well, there are some borrowers who can even get AWPLR minus, I believe. legal loan plus. So that is a factor of the credit risk as perceived by the banks, and
it's a purely banking perspective.
Yeah, it is because it is. I think it is perhaps not. Shall I say? It is difficult for the central bank to go and ask how the bank should price risk.
No. Now, on the monetary side, it is you all that are doing it. Now, there I don't see any priority lendings of the central bank. Earlier, there was direction.
No, we have not gone and do any directed lending.
Earlier, there was a way that the government's policy could be created through youth, or whether it is SMEs or something. But now that is not there.
Yeah,
so on that score, how do you basically resurrect certain areas which have gone through some unusually painful development? Now, there is a battle on these SMEs.
So those have to be done on a one-off basis, on a case-by-case basis. You'll have to deal with those, I think, which are getting done, I think. Even as we speak, there are some discussions going on that.
As those sectors are quite relevant in the economy, which is roughly 60 to 65% of the economy. So you can't let things heal by itself. It will take that much of time.
So there are some.
So how do you? Because government's hands are tied, but now in the new aspect, it has to be led by something. So there is no priority lending at all.
Honorable Member, Mr. Fonseca, that is 6.3, shall we, this is substantial
Sorry,
matter, no?
I have to leave for the business meeting.
Ah,
So
right.
if you
Okay,
don't
okay.
mind, then I can ask and then you all can.
Sure.
So I just want a clarification because I feel that there needs to be an impetus that is given to stir business in this type of environment.
Well, one can argue that is actually a matter for the state, in the sense it is.
But the state can't do
No.
areas of monitoring.
What I mean is to providing through the fiscal certain amounts of support to these sectors or whatever it may be.
But there are fiscal also on this first year, where the public fiscal management, you are constrained with 13% spend. So, I mean, you are giving the government a harder task. So, as the Secretary Finance doesn't get involved in the monetary board, so how does the government's policies get incorporated into the economy?
So government policy is incorporated, the mandate given by the government to the central bank through maintaining inflation and financial system stability. That is the government policy mandate given to central bank.
So that's the 5%.
5% inflation and maintaining financial system stability.
So that's
that's
the
why
only leverage that is.
Yeah.
Now, just we asked this question last time, Governor. The concept of 5%, you
Yeah.
think is that, that is the government accepting your cost of goods will increase 100% every 12 years. If that is the acceptance of the government.
Yeah.
So on that score, you think is that something which is worthwhile, or is there a better way you can reduce? Because these are relatively technical things. So on that particular basis, all I could see is there's only one direction. You're only expecting an inducement that is there. So GDPs in real terms don't grow, in nominal value it grows. So on that score, do you see 5% too high? Do you think it's better to have a lower rate, or what are the ramifications?
No, I think we had a discussion even last time, what is the appropriate inflation for a country like us. Say advanced countries have 2 to 3% inflation target. Then you have to maintain a very tight monetary conditions to maintain that kind of target. Basically, mainly when you have a large volatility inflation, maintaining low interest rates 2% or 3% means you have to maintain a very tight monetary condition. That's not good for an economy like Sri Lanka. So basically this 5% has coming out of a lot of research done before the number is determined and compare our level of countries' development stage. For example, India is 4%. There are other countries 5%, some are 6%. In the US, Europe, Australia is 2 or 3%. I don't think we are ready to have a low inflation. I mean, it's up to the government. Government decide, give us a mandate, you bring down inflation 2%. If you want, we can bring it down. Then we have to raise interest rates further to tighten the monetary conditions.
But Governor, you're basically, while accepting that, you're having a deflation that has been going on for 18, 19 months.
That's what we are going to explain. This report is that.
So over that passage, you also answer the minister saying gestation period is also 15 to 18 months. Yeah, so if by chance now you want to rectify that, it will take another 1.5 years. So I'm saying is government policy, the governments may have different policies, so they want to on one side curtail expenditure, increase activities, etc. So they're caught up in between. So I'm asking as to how you all can respond to that thinking process.
No, that's why I said our mandate is different. Sectoral developments, SME developments, tourism sector, industry sector, ports, there are different agencies to promote those exports. That's why central bank can't do everything. So basically we have been given a mandate, that's our responsibility, we try to deliver our mandate. Anything else beyond, if we confuse those things, that's a mistake we had in the past. Long time ago, that was the Central Bank Act was revised back in 2001. If you can remember earlier, there was a development objective. Like some central banks at the beginning, we had this development objective. That's where we had central bank was giving credit to the sectors, greater credit. Those were there about say 3 decades ago. We are moving to a different kind of situation.
So you got my word. So development aspect is void at this moment.
Development aspect is responsibility of the state. So that's why the legislators are there to bring in whatever policies to meet that objective.
So credit is not considered a variable for development in new way of thinking.
Yeah, now, is that, with the central bank's independence in this aspect, is it matched with the Fiscal Responsibility Act, which constrains with the IMF thing 13% and all? You're basically putting a government into a straitjacket operation.
No, that
No, but at the end
fiscal.
of the day, that's delivery. I mean,
think
you'll have a patient successful, operation successful patient.
No, government has obviously choice to deviate from the fiscal targets. That's up to the legislature to do
But
that.
tell
if they
the
want.
governor, how is it now, you're basically having costs bought at 13%, out of that capital expenditure, then your revenues, whatever it is collected, it has to be X amount, you can't go beyond that, so you can't use that revenue into expenditure. So how do you get things moving?
I think that discussion
Yeah, this is the
will
first
have
time
take
these
place at
operating.
different forum, Chairman. I don't think this is.
No, that is why, I wanted to
No,
move
but
this.
that's the relevance we are asking.
No,
We don't want it remote control, it's not a remote control operation. We want to see as to how this will percolate down into the economy.
Yeah, I mean, this is a broader discussion and a substantial one. That is what I wanted to shift it to after the presentation, but the honorable member had to go, so that is why I gave him that time. But I just want to make one point. I mean, you have two primary objectives, and in section 6.3, it very clearly says, without prejudice to the attainment of its objects, and subject to the provisions of this act, the central bank shall support the general economic policy framework of the government. So there is that link. So you're not completely mutually exclusive. There is a link, but that link is indirect and not direct as it used to be. That I think is the specific. Doctor, will you please, Sujita?
Chairman, my suggestion for us to also now, our focus is on this matter. This is a larger debate, important one, but let's focus on to this matter. Otherwise, we'll be putting them in an uncomfortable position, also the officials and all. So
no, I
our
don't think it's
position is-
uncomfortable. I think it's very good to have a healthy
It's the most
debate.
relevant factor of it.
Yeah.
As the government, we are concerned of this much more. But the concern is we need to manage time. Team members would have prepared and come for a particular discussion. Otherwise, we won't be able to focus on this discussion if we deviate too much. If this is an important discussion, let's agree among the committee members. With the concurrence of the committee members, we will call them for another
Honorable
discussion
Minister,
also.
the Honorable Minister,
My
that-
request.
Yeah, Honorable Minister, the Honorable MP said that he had to leave, and that is
Yeah,
why
for
he
business
requested
meeting.
for time.
Business meeting.
Right, he has a business meeting.
No, but end of the day, I mean, we know 90% of what's going on, we know, but these are the areas which are the ones that are volatile.
That's
so I guess
fun.
getting answer to this is far better listening to a tuition lesson. So, I mean, let's get moving as to SMEs, there are issues, investors are wondering, returns are there, pending aspect is reduced.
Agree among members.
Sure.
The chairman to call for a.
No,
So, Governor, is there any way that we could look at you all recommending priority lendings to the youth, the agriculture? Is there any way that you could say X amount? And what are the drawbacks if you do so?
Yeah, so let's, shall we sort of?
Yeah, take that last
Yeah, we'll take it, make a note of that. We can, if we have time, we can get into this.
Or what you
debate.
all could do is send that as your written this into.
Yeah, no, I think it's
I mean,
good to
those
have
are
a discussion. It's because this is a fundamental point, no, that new central bank act was brought specifically to remove the central bank from intervening, playing a role in the development process. Money cannot, in my view, create growth. Monetary policy cannot create growth. Monetary policy, in my view, can stabilize the economy in the short term, but there has to be real growth that has to come from reform. So this is a ideological debate which you and I may not necessarily agree. So therefore, we don't need to get into that now. But we can have 3-4 hour discussion, because I think that's what is important, like the honorable member said. So
Yeah, I
I'm
think,
willing willing to have a broad debate. We can have the treasury, we can have the central bank, we can have the ministers, and we can have an
We should
intellectual
have
discussion.
that as a country.
Yeah,
And
because
we can do that. I'm ready to do that.
Chairman,
We can make a note of
the
that.
main thing is now the exchange rate is very volatile. Where the exporters are looked at that when you have domestic inflation going up. Then the balance of payments. All these are outside the aspect of government. So I am only looking at your problem and asking that, because I can see those are the relevant issues. I mean, those are what percolates down the people. So just keep that in mind if you can.
We'll have a-
As time is limited thing, you know, send that in writing to the.
No, we'll schedule a 4-hour discussion. I mean, we'll have enough time. I mean, this is an important matter. Yeah.
We will see the results by end of this.
Yeah, we will do that. We will do that. We'll have a half-a-day seminar. Fine. Let's do that. But Dr. Sujita, please.
Yeah. As Governor explained, this monetary policy, when we do a monetary policy decision, that is passed on to the final objectives of meeting the inflation target. So that takes around 12 to 18 months, but the transmission happens through the interest rates mainly. So the immediate transmission happens to the market interest rate, particularly the short-term market interest rates will get adjusted when we do a change in the interest rate. And later that will have an impact on the bank lending as well as the deposit rates. So we have shown the chart as well as the table to show how an 8% change that we have done from mid of 2023 up to now has translated to into a changes in other market interest rate. You can see that the AWCMR, which is the operational target of the current policy regime, has changed in line with the policy rate adjustment, more or less same as around 8%. But we could see that has brought in more transmission to other interest rate, because at the time of the crisis, the other market interest rates were much above the policy interest rate. So that with this policy easing, we could see that most of the rates have adjusted substantially compared to the peak that we observed in 2022. For example, if I can quote the 91-day treasury bill rate, we could see that it has declined by more than 23% compared to the peak in 2023. So that translated into lower interest cost to the government. Similarly, if I can talk about the lending rate, average weighted lending rate, which is applicable to the private sector, that declined from for 8% change in the policy interest rate, we could see that has declined by more than 15%. And a similar adjustment has happened in the deposit rates and the 1-year T-bill rate and the prime lending rate. So this shows that for the monetary policy easing that we have done so far, we have seen that market interest rates have adjusted fully. So we can say that there has been a complete pass-through to the interest rates. And since the external sector discussion was also there, we would like to discuss a bit about the external sector development as well. We have observed that the current account surplus has improved, and during the first 4 months, we have recorded 1.1 billion current account surplus. We started publishing monthly current account starting from January, and the projection suggests that this year also we will be recording a current account surplus, 3 consecutive years of current account surplus. This is the first time in the Sri Lanka's history. And earlier, so there were arguments like that could be because of vehicle import were not allowed, but even with the vehicle import, we expect that there is a possibility of recording a surplus this year as well.
So current account, what is the sum of?
So that will be a sum of the trade balances, imports and exports. There we have a deficit, and then we have
Is that deficit growing?
That is growing. That was expected when we relax these import restrictions and we see economic recovery happening. So there is a demand coming from consumption, intermediate and investment goods. So imports are picking up. Export is also growing, but at a lower rate. So we see trade balance is widening. But the primary account is the next, primary income account is the next category that shows our interest related payments. That has relatively come down after this debt restructuring. So we see a manageable primary income deficit. So in these 2 accounts we have deficit. Then we have the services sector surplus that generates surplus. The main surplus is coming from tourism. And also there are other services sector. So from other services sector also we are generating a surplus. So altogether services sector account is generating a surplus. And the next part is the secondary income that mainly covers the remittances and we see a notable surplus in that category. So because of services sector surplus plus the remittances, we see current account becoming surplus.
And why don't you think your point number 2 on interest, now we pay very little now? So that also may be playing a significant role in your outcome.
It's not actually a major difference, because even earlier, even though we were in the debt standstill period, it's on an accrual basis. We have been recording what was due for that period. And compared to, so we were talking about around 2.8 billion those days, and this has come down to around 2.3 billion now. Going forward also with this debt restructuring, we expect it will be at a manageable level. Less than 3 billion deficit will be there for the upcoming years also. That will be manageable through workers' remittances and the services sector inflows.
There's a slight drop in the reserves in April. Can you explain why there is a drop?
So the reserve is actually calculated. So there are two major components coming in the gross official reserves. One is the reserves held by the central bank, and the other component is called DST balance, that is the government portion of foreign reserves held at the central bank, DST balance. So these two components are the major components of the reserves.
How
So
much? Sorry, go ahead.
There will be inflows to those two reserves and also outflows. So inflows, when we receive new loans, we get inflows. And for outflows, it will be, and also when we buy from the market, domestic forex market, when central bank buys, that becomes a inflow, so our reserves will increase. There will be outflows, so mainly in terms of debt servicing. And so the monthly changes in gross official reserves will reflect the changes in the inflows and outflows.
What specific outflow are we seeing here? Is it debt servicing?
Debt servicing mainly, yeah. We bought also. In April, central bank bought also. On top of that, there were some debt servicing payments to the government also.
Sorry, please go ahead.
When you buy from the market, it has indicated 900 million on net basis.
Yeah.
So you make use of the dollars that are the forex that are available there, based on the remittances that we receive, exports,
and the export proceed conversions.
and FDI also, what we have got into the country.
Possible if those
So you
those come
will,
to the market.
central bank will have visibility of the FDI that is coming into the country.
Not directly. We actually get data from BOI for FDI. When we are recording FDI in BOP, we get it from BOI. These are like daily inflows and outflows. So whatever that the banks are having excess will be served for demand for forex from the market, as well as maybe our purchases. So if we have a net inflow in a day, we will be buying. So that will be added to the gross official reserves.
So you will have, you will not know the exact details of how much came in for FDI into the country from the central bank side.
Yeah. So workers' remittances and export proceeds, it's easy for us to get daily reports, but FDIs, I don't think we have a separate category to.
What about the outflows of remittance? Is that also not recorded?
Everything is recorded in the balance of payment on a quarterly basis, not on a daily basis.
Reflected in here?
Yeah, yeah.
But that information you don't kind of keep a track, there's no tagging or something that we can, you all can identify those information, remittances, like, I know you all have the details in terms of remittances.
Yeah.
Similarly, FDI that is coming into the country.
So FDI.
If I may clarify, we
Yes,
have
please
this monitoring system called International Transaction Reporting System that we developed recently, where banks are reporting to us online based on the codes. We have given them, okay, this transaction they have classified, this is portfolio investment, whether it's FDI, whether it's import, export, there's categories there. But this usually FDI, difficult to trace this inflow when it comes in, because depending on, because banks usually, for example, the BUI company bring that money in, for example, they report to the bank, this is a inflow to this company. It could be in the form of imports, expenditure for this BUI company. So it comes as the imports. Then corresponding entry, we will get that information only from the BUI. Then BUI reports to us, this BOI company, how much they have brought in as foreign direct investment, out of which what is what used for imports, what used for domestic investment. On that basis only we classify on quarterly basis in our balance of payment compilation. That is where the more detailed information. But daily basis is difficult to monitor this kind of transaction. Only exports, imports, remittances are easier because the regular banks can easily identify. Other transaction, it has to come from the source of the company.
Governor, is it correct to understand? So going forward, based on this tagging system, on a quarterly basis, central bank will have visibility as to how much of FDI coming in?
Yes, even now we publish quarterly balance of payment, which gives all the lines.
Okay.
Details of inflows, outflows.
Why I ask, otherwise we have to ask, rather rely on BOI to provide that information. But if it's available and if central bank is publishing that one, how much of FDI that has come into the country, then there's no necessity for us to get that from BOI.
This thing is that we have to rely on BOI. One of the problem there is, Honourable Minister, so the primary source of information is Board of Investment.
Fair enough.
They have a primary source. Basically, we rely on BOI, but they have to give us information on breakdown of, basically BOI definition includes even what they have, the retained earnings. Also considered as a reinvested here, there's no cross-border transaction there. Even we company take a loan, if that comes in, that's also part of that. So basically that's where the BOI FDI inflow includes reinvested earnings, borrowings and direct investment, the three categories. So BOI has information from each and every company, what was retained earnings, what was the net FDI inflow and what was the borrowing component or from the parent company. That information we don't get that. That's we have to rely on BOI, otherwise it's not right for us to challenge the primary source of information.